Hello, my dear students. Welcome back to Shri Hari Ragavendra Academy. Today, I am taking you through a new module called Marginal Costing. Before beginning the module, let us take a blessings of Hayagriva Swami and Saraswati Devi. Gnananandamayam Devam Nirmala Spatika Krutim Adaram Sarva Vidyanam Hayagrivam Upasmahe Namaste Sharadha Devi Kasmira Puravasini Vidyarambham Karishyami Siddhir Bhavatu Me Sada. So let Lord Hayagriva Swami and Saraswati Devi bless you all with a good knowledge, wisdom, success in your life. Guys, welcome back. Please do subscribe to the channel and hit a like button, and also click on a bell icon to get a further notification whenever I upload a new video. Okay. Before beginning a class, today let me try to make you all understand a cost. What is cost? Cost is actually an expenditure incurred to buy something, to manufacture something, etc. So guys, if I wanted to sum it up, a cost can be of two types. One is fixed cost, the other one is variable cost. So total cost can be classified into two types, variable cost and fixed cost. Now what happens in the case of fixed cost? It remains fixed. The best example is rent. If a company wants to produce 10 units, then the rent paid is 10,000. If a company wants to produce, rent paid to a godown, usually say for example, if you are manufacturing one unit, the rent is 10,000, which is fixed. If you are manufacturing two units, the rent you have to pay is 10,000. If you are manufacturing 3 units, the rent you have to pay is 10,000. So what is happening here is, irrespective of the number of units that you are producing in the factory, the rent is fixed. Now, as the owner of the company, as it is fixed, I am least bothered about the fixed cost because it remains fixed. I am not worrying about it, but I am more concerned about my variable cost because it is directly varying in accordance with the number of units that I produce. Say for example, if for manufacturing one unit, my variable cost is 10 rupees. Okay, if I manufacture one unit, what is my variable cost? My variable cost is 10 rupees. Now tell me, if I manufacture, say I'll write it here. So if I produce one unit, cost is 10 rupees. That is 1 unit into 10 will be how much? 10 rupees. Okay. Now rent which I pay is 10,000, as I've already told, which is fixed now. Okay. Now if I'm manufacturing one unit, the variable cost is 10 rupees. Total cost, as I've already seen the formula, total cost is equal to total cost is equal to variable cost plus fixed cost. Now what is variable cost here? 10 rupees. What is fixed cost here? 10,000. So what is the cost? 10,000. 10 rupees is the cost, total cost to manufacture one unit. Now case number 2, if I produce 2 units, which is of 10 rupees. So what is the variable cost now? 20 rupees, isn't it? 2 units into what is my variable cost? 10 rupees. So what is total variable cost? 20 rupees. Now what has happened to my rent, which is fixed? I produce 1 unit, or if I produce 2 units, my rent is fixed here. It is not getting changed. Now how do we calculate total cost? Variable cost plus fixed cost. What is variable cost now? 20 rupees. What is fixed cost? 10,000 rupees. Now what is total cost? 10,000, 20 rupees. Now if I am manufacturing 3 units, what is the cost? 3 into 10, 30 rupees. What has happened to my rent? It remains fixed. So how do we calculate total cost? Variable cost plus fixed. What is my variable cost? 30 rupees. What is my fixed cost? 10,000 rupees. Now 10,000, 30 rupees. Now what did you understand from this? So conclusion is very clear. Fixed cost remains fixed irrespective of the units produced. Keep this in mind. So I am not worried much about this. I am very much worried about the calculation of the variable cost. I just want to know what is the extra cost that I am incurring to manufacture one additional unit again and again. Getting my point? What is the additional cost that I incur to manufacture one additional unit is measured with the help of variable cost. If I am manufacturing one unit, the variable cost is 10. If I am manufacturing 2 units, what is my variable cost? 20. What is the level of increase from 10 to 20? 10 rupees. So in order to produce one additional unit, I have to incur extra 10 rupees. Getting my point? What is the additional cost that I incur to manufacture one additional unit is measured with the help of variable cost. And to sum it up very simple, I can write it like this: my marginal cost is nothing but variable cost. So it helps me to analyze what is the additional cost that I incur to manufacture one additional unit. Say for example, if I am manufacturing 2 units, my variable cost is 20 rupees. If I just want to increase it by 3 units, what is the level of increase from 2 to 3? 2 units to 3 units, it is 1 unit increase, right? So in order to increase 1 unit, what is the level of cost that there is an increase here? From 20 rupees to 30 rupees. What is the level of increase? 10 rupees. So what is the conclusion? If I have to increase my capacity by 1 unit, the cost which I am incurring extra is 10 rupees. So in order to manufacture one extra unit, I have to incur the total cost of additional 10 rupees here. Getting my point? That is what we measure in the case of marginal costing. See, now you can understand here. Marginal costing is a technique where only variable costs are considered as product cost. We got to see here variable costing. This is all called as variable costing. All this leaving rent apart, all these are considered as variable cost as a product cost, because your product cost is getting changed, right? Here it was 10 rupees. If you when you are manufacturing 1 unit, when you are manufacturing 2 units, your product cost become 20 units. When you are manufacturing 3 units, your product cost became 30 rupees. So your product cost are basically calculated with the help of variable, because this is fixed. See, if you are manufacturing 1 unit also, 10,000 was fixed. If you are manufacturing 2 units also, rent was fixed. If you are manufacturing 3 units also, rent what was fluctuating every time? Variable cost was fluctuating every time. So we considered variable cost as a product cost and fixed cost as a period cost. This is a period cost. 1 month is considered as period. So during this 1 month period, your fixed cost will never get changed. So this is what the meaning is trying to tell you. In simple words, marginal costing helps us to understand how cost changes when production increases or decreases. How, I will just particularly underline here, how cost changes when production increases or decreases. See here, marginal costing will help us to understand how cost changes, right? See here. Again, marginal costing is nothing but variable cost. These are all variable costs. See, when you were manufacturing 1 unit, cost was 10 rupees. When you were manufacturing, when you just increase the capacity, when production increases, what was the cost? 20 rupees. When production increases, what was the cost? 30 rupees. So marginal costing helps us to understand how a cost changes when production increases or decreases. Similarly, say for example, I am manufacturing 3 units. Now I don't want to manufacture 3, I will manufacture only 2 units. What was my cost now? 20 rupees. So did you understand what I'm trying to tell? Now let us move on with this simple example. Now if a company wants to produce the 100 units, okay, of a product, the cost for each unit are given as follows. We have direct material 50, direct labor 30, variable overhead 20 and fixed overhead 40 rupees, which means that this is fixed in the form of rent paid to the godown or to the factory place. So this 40 rupees are excluded here, because this will never have an impact on my product, because it will always remains constant. What will have an impact on my product? 50, 30 and 20, because these are all variable. 50 plus 30 plus 20 will be 100. So what is the marginal cost now? 50 plus 30 plus 20. This variable cost, these are variable cost, is called as marginal cost. So 50 plus 30 plus 20 is 100 rupees per unit. What does it mean? To manufacture 1 unit, you need 100 rupees of variable cost. Getting my point? Now if you want to manufacture 2 units, what will be your variable cost? 200 rupees. If you are manufacturing 3 units, 300. If you are manufacturing 4 units, 400. If you are manufacturing 5 units, 500. This means that when a company produces one more unit, cost increases by only 100 rupees, because we never take this 40 rupees into consideration, because it will remain fixed. As we also saw in this example, 10,000 was never getting fluctuated, only the variable will get fluctuated. So if a company produces one more unit, the cost will be only increased by this 100 rupees, okay, not by 40 rupees. So marginal cost is nothing but your variable cost. What are the features of marginal costing, guys? So one of the important feature of marginal costing is only variable cost is considered. We saw through an example. So also fixed costs are never considered as a product cost, because it never gets fluctuated. We consider only variable cost. Then fixed charges are for one accounting period. What does it mean? I think first one you got to know, we consider only variable cost. Then fixed charges are for one accounting period. That is what fixed cost are for one accounting period. It will never get changed. So this is what this point is explaining. It is fixed for one particular, say for example, now rent is fixed for an year. After an year you will have a 5% increase on the rent, but till for the one accounting year, your rent is fixed. Now marginal costing helps in a decision making process, very importantly for pricing. Now if I want to fix the price of the product, at what should be my selling price of the product, all these are decided with the help of this marginal costing. Or say for example, now if in order to manufacture one unit, I require a variable cost of 100 rupees. Say for example, now if the product is readily available in the market at 80 rupees, then why should I incur extra 20 rupees by manufacturing in my factory? So instead of making the product, I can directly go to market and buy the product. So in order to make a buy decision or make or buy decision, this is fantastically done in all the organization in order to reduce the cost. Say for example, in order to make a product, if you are incurring 100 rupees, if the same product is already available in the market at 70 rupees, then which is best choice? Making it in the factory by spending 100 rupees, or buying it from the market by using 70 rupees? Which is best option? 70 rupees is best option. This can be determined with the help of the marginal costing technique. Then profit planning. If the total cost, say for example, now 10 plus 10, 1010 rupees, 1020 rupees, 1030 rupees, then what should be my selling price of the product? So if the cost itself comes around 1010 rupees, my selling price should be somewhere around 1030 to 1050 rupees. So my selling price should also include the profit. So in order to calculate the profits, I need the help of marginal costing. Then profits will depend absolutely on the sales volume. What does it mean? That the profit earning capacity depends upon the number of units that you basically sell in the market. So that I will be showing you through a demonstration. Okay, now say for example, let us move to a very simple case study problem. A small coffee shop wants to know what is the minimum number of coffee to sell in order to earn the profits. I just wanted to have a discussion on the fifth point, right? So profit depends on sale volume. Let us try to understand with this simple example. Now the coffee shop wants to know what is the maximum number of coffees to sell in order to earn the profits. Now these are the details of financials which they have given. So a coffee shop, basically what do they want? A coffee powder is 20 rupees per cup, sugar 15 rupees per cup, and we need a cup to serve a coffee, which is 10 rupees per cup. Then we have a shop rent, staff salary, electricity. Now guys, these are the expenditure which is actually given. Now we have to basically segregate this entire expenditure into two classification, which is fixed cost and the variable cost. Say for example guys, now coffee powder is 20 rupees per cup. Say for example, if you sell one cup, then you need 20 rupees. If you sell 2 cup, then you need 40 rupees. If you want to sell 3 cup, then you need 60 rupees. So this is variable cost. Then milk. if you are selling 1 cup, you need a milk of at least 15 rupees. If you are selling 2 cups, then the cost will go to 30 rupees. If you are selling 3 cups, then the cost will go to 45 rupees. So based on number of cups that you sell, even the cost of the milk is getting fluctuated. Then sugar, in order to serve a 1 cup of coffee, you need at least a quantity of sugar worth of 5 rupees. Then if you are selling 2 cups, then sugar cost will increase to 10 rupees. If you are selling 3 cups, then sugar cost will increase to 15 rupees. So this is variable costing. Then cup to serve the coffee. If you are serving 1%, the cost of the cup is 10 rupees. If you are serving 2%, the cost of the cup will be 20 rupees. If you are serving 3%, the cost of the cup will be 30 rupees. So this is all a variable cost. Coffee powder, milk, sugar and cup are considered as your variable cost, and I explained you how it is considered as variable cost. Then we have a shop rent. Guys, this is fixed. Whether you sell the coffee for 1%, whether you sell the coffee for 50%, whether you sell the coffee for 50,000%, rent is fixed. Staff salary, you need at least 2 employees to work in your coffee shop. Then even their salary is a fixed cost, because you never fix their salary based on the number of cups they sell, right? So that is fixed cost. Then electricity, partly it is fixed. I will never say it is completely fixed, because minimum number of units are taken into consideration, which is fixed. So I am considering these 3 as fixed cost and these 3 are variable cost. Now let us try to understand, as we already know variable cost are considered as variable cost is equal to marginal cost. So 20 plus 15, 30, 35, 40, I think it come around 50 rupees is your marginal cost, right? Let me try and calculate. Yeah, 20, 30, 40, 50. So my marginal cost will be 50 rupees, because you already know the formula. Marginal cost is nothing but your variable cost. Then we have a fixed cost, and 18 plus 2 will be 20,000 is considered as fixed cost. Okay, now this particular business is selling the coffee at 80 rupees per cup. Okay, now let me try and help you out in calculating the contribution per each cup. Okay, now contribution is equal to selling price minus variable cost. So out of 80 rupees of sales price, first you deduct your variable cost, that is your marginal cost. So marginal cost is nothing but your variable cost. It can also be called as variable cost. So what is your variable cost? 50 rupees. So out of your sales, that is your revenue, basically you have to deduct your expenditure first, which is around 50. So I think 80 minus 50 is remaining will be 30 rupees in your hand as a revenue. So 80 rupees was your sales price, out of which you recovered all your variable cost of 50. So 30 rupees will be the remaining cup. Now out of this 30 rupees, you need to cover this fixed cost also, right? So how do we calculate break even point? Now break even point is equal to fixed cost divided by contribution. What is your fixed cost here? 20,000 was your fixed cost. Now break even point is a point where we term it as no profit or no loss, because it helps you to determine how many number of cups that you have to basically sell in order to earn the profits. This is BEP in terms of units. So now what is contribution? 30. So this will come up to 667 cups. So what does it mean? That at least you need to sell 667 cups in order to enjoy the in order to at least recover this fixed cost, guys. Try to understand. Okay, so basically how does it works is, say for example, now 667 into 80 to 30. So you need to at least sell 667 cups, because 667 cups into what is the remaining, because when you recover your full variable cost, remaining left out profits are only 30 rupees. 67 into 30 will basically come around 20,000 rupees, 20,010 rupees, but I am rounding it to 20,000 rupees. What does it is actually denoting is, in order to recover this 20,000, at least you need to sell 667 cup. Say for example, if you are selling only 500 cup into 30 rupees, 500 cup into 30 rupees, you will land up by paying 15,000. You will land up by only earning 15,000, which is loss, because you are not in a position even to recover your fixed cost. Say for example, if you are selling 700 cups into 30, we will just calculate it, 700 cup into 30, now you will come up by 21,000, which is your profits. What is your profits now? What is the profits? Guys, remember, you have a total sales of 21,000. Out of this 21,000, recover your 20,000 of fixed cost. Now profits are 1,000. So this is your profits. So BEP is basically teaches us what is the minimum number of cups that we need to sell to recover your fixed cost, because out of your sales price, first we will recover your variable cost, that is your marginal costing is recovered. Out of this remaining will be 30 rupees. So from this 30 rupees we need to settle our fixed cost. So we need to know what is the minimum number of cups that we need to sell. So based on that, we have a formula to calculate BEP, that is fixed cost divided by contribution. Fixed cost was 20,000 will be what is contribution remaining per unit 30. So 667 cups, which says that minimum number of cups that we need to sell at least to recover this fixed cost. Okay, so if we are selling exactly 667 cups, we are no profit, no loss, safe zone. If we are selling 500 cups, then we are in a loss. If we are selling 700 cups, then we are in the profit. So this is what marginal costing. So in short, if I have to tell, marginal costing is a technique in which only variable costs are taken into consideration and fixed cost is period cost. So with this, I am closing this introduction module of marginal costing. If you do have a doubt or if you do have a confusion, then you can put up the same confusion in the comment box so that I will be replying to you all. So if you like the video, please hit the like button and please do share the channel and subscribe to the channel.